Hello everyone, welcome to my course on capital investment. This is module 5 of this course. In this module, we are covering capital budgeting cash flows, and this is the third lecture of this module. In this lecture, we will cover how to find initial investment of a project. Now, let's look at the basic format for determining initial investment. To find out initial investment, first of all, you need to know the installed cost of new asset, which is equal to cost of new asset plus any installation cost related to the new asset. Then we have to deduct after tax proceeds from sale of old asset, that is equal to proceeds from sale of old asset plus or minus tax on sale of old assets. So tax will depend whether there was a gain or loss from the sale of old assets. Finally, you have to adjust change in net working capital. If change in net working capital, if there is an increase in change in net working capital, you have to add it. If there is a decrease in change in net working capital, you have to deduct it. And finally, you'll find the initial investment. Now let's look at some terms over here. So the cost of new asset is the net outflow or net outflow necessary to buy a new asset. Then there could be some sort of installation cost which will be added with the cost of new asset, and if we add cost of new asset with installation cost, we'll find installed cost of new asset. So installed cost of new asset is equal to cost of new asset plus any installation cost. Now the after tax proceeds from sale of old asset are the difference between the selling price of old asset and any applicable taxes or tax refund related to the sale. So the proceeds from sale of old asset are the cash inflows, net of any removal and cleanup cost. The tax on sale of old assets depends on the relationship between the old assets selling price and old assets book value. Then you have to apply any tax rules, existing tax rules of the government. And one more term, which is book value. Book value is simply installed cost of an asset minus accumulated depreciation. So here is the rounded depreciation percentage by recovery year using MSCRS for first 4 property classes. MSCRS means modified accelerated cost recovery system. Say for example, if the asset class belongs to 3 years, it means for the first year you have to count 33% depreciation. For the second year you have to count 45% depreciation. For the third year you have to count 15% depreciation, and for the fourth year you have to count 7% depreciation. This way you have to count depreciation for asset which belong to 5 years, 7 years and 10 years. Now let's look at how do we find out book value of an asset. For example, Hudson Industries bought a machine tool about around 2 years ago with an install cost of $100,000. The machine is depreciated under MSCRS for 5-year recovery period. As it was bought for 2 years ago, depreciation for first years under MSCRS 5-year recovery period is 20% and for the second year is 32%. So over the 2 years there will be in total 52% depreciation. That's 20% plus 32% of $100,000, which is the install cost of the machine, or the accumulated depreciation is simply 52%, which is 52% into $100,000, which is the install cost of the machine. In this case, book value of this machine at the end of year 2 is 100,000 minus 52,000. So book value is $48,000. Now let's look at the tax treatment on sale of old assets. Say for example, your tax rate is 40%. In this case, if there is a gain on sale of assets, that means all gains above book value are taxed as ordinary income. If there is a gain above the book value, you have to pay 40% tax on your gain. However, if there is a loss on sale of assets, whatever is the case, there will be a 40% of loss is a tax saving. Now let's look at how do we calculate tax. So here we are assuming that sale of the Hudson Industries assets, selling price of the Hudson Industries asset is $110,000. So in this case, the realized gain will be 62,000. That's the selling price of this asset, which is 110,000 minus 48,000. Previously, we found that the book value of Hudson Industries asset is $48,000. So based on this book value, gain on sale of this asset is 62,000. There are two parts of this gain. Number one is a capital gain and recapitulated depreciation. The capital gain of this asset is $10,000. That's the difference between the selling price of this asset minus the initial purchase price. In this case, selling price of this asset is $110,000 and initial purchase price of this asset is $100,000. So the capital gain is $10,000 and the recapitulated depreciation of this machine is $52,000. So in this case, total gain is 62,000. That's the recapitulated depreciation 52,000 plus $10,000, or we can simply find the total gain in this way. So that's the selling price, which is selling price of this asset, which is $110,000 minus the book value of this asset, which is 48,000. That's $62,000. So the total gain above the book value is 62,000 and is taxed as an ordinary income at 40%. So the tax on gain will be $42,800. So that's 40% tax rate into $62,000. That is which is the total gain from the sale of the old asset. Now assume that the selling price of this asset is 48,000, which is equivalent to its book value. In this case, there will not be any tax from selling this asset, as it is the selling price is exactly equal to the book value. There will not be any gain, so there is no tax effect on this case. Now, again, we are assuming that the selling price of this old asset is 30,000. It means there is a loss of $18,000. So the book value of this asset is $48,000 and the selling price is $30,000. So there is a loss of $18,000. So if this asset is depreciable asset used in the business, the firm can use the loss to offset ordinary operating income. If the asset is not depreciable or is not used in the business, still the firm can use the loss only to offset the capital gain. In either case, the loss will save the firm $72,000. So that's 40% into 80%, 1,800,000. So $72,000 tax will be saved by the firm as there is a loss on sale. So if the current operating earnings or capital gains are not sufficient to offset the loss, the firm can apply these losses to prior or future years' taxes. So the conclusion over here is that if there is a loss on sales of an old asset or sale of an asset, the firm will be able to save some taxes on its current income or future year on its current taxes or future years taxes. Now let's look at the concept of net working capital. Net working capital is the difference between the firm's current assets and current liabilities. The formula of net working capital is equal to current assets minus current liabilities. To find out initial investment of a firm, so find out change in net working capital, which is simply the difference between change in current assets and change in current liabilities. If the change in net working capital is positive, it indicates that there was an initial outflow. But if the change in net working capital is negative, it indicates that there was an initial inflow. So here is an example of how do we find out changing net working capital. So assume that as a result of new installation of an asset and selling of an old asset, there was an increase in cash 4,000. There was an increase in accounts receivable 10,000, and there was an increase in inventories 8,000. All are current assets, so there was an increase in overall current assets by 22,000. And accounts payable increased by 7,000 and accruals increased by 2,000. So there is an increase in current liabilities by 9,000. So overall change in net working capital is $13,000. Here is an example or exercise on finding the initial investment. So over here we will calculate the initial investment. Let's assume that Pal Corporation is trying to determine the initial investment required to replace an old machine with a new one. So the purchase price of the proposed machine is $380,000, and there is also an additional $20,000 installation cost. So install cost of this machine will be $400,000. So here is the calculation. Install cost of the proposed machine. So cost of the proposed machine is $3,800 and installation cost is $20,000. So total install cost of the proposed machine is $400,000. Now the new machine will be depreciated under MSCRS 5 years recovery period. The old machine was purchased 3 years ago at a cost of $240,000, and the old machine was also depreciated under MSCRS using a 5-year recovery period. So there will be depreciation. There will be depreciation for 3 years, accumulated depreciation for 3 years. Now let's look at the MSCRS depreciation table for 5 years asset class. So if the recovery period is 5 years, for the past 3 years there will be depreciation like 20% for the past years plus 32% plus 19%. So 20% plus 32%, that's 52%, plus 19%, that will be, that's in total 71%. So there will be a 71% depreciation on this install cost of the old machine. Then we'll get the book value. So using the book value, we'll find out the gain. Then there will be a tax, 40% tax on the gain. So based on this information, so after we need to find out after tax proceeds from the sale of old machines. So proceeds from the sale of old machine is $280,000, and tax on sale of old machine based on this information is $84,160. So after tax proceeds from the sale of old machine is $195,840. Now let's look at the change in net working capital. The firm expects that there will be an increase of $35,000 in current assets and an increase of $18,000 in current liabilities. So based on this information, there will be a positive change in net working capital. So we have to add the change in net working capital by $17,000. So based on the above calculation, initial investment for the farm will be $221,160. That's all about this lecture. In your next lecture, we will learn how to find out operating cash flows.